If you've already heard about an IUL, you've probably heard things like be your own bank, get the gains out of the market without suffering the losses, and unlike a 401k, access your money anytime without penalty, tax-free. And if you're like most people, you're probably wondering, why haven't I heard about this before? And the answer is pretty simple. When most people are thinking about financial solutions to build wealth, they're not thinking about life insurance. They think about stocks, 401ks, real estate, and saving money. Life insurance usually comes up when people are thinking about death, not while they're thinking about something to build while they're still alive. And that's where an index universal life policy, or an IUL for short, comes into play. IULs were first introduced in the 1990s, and over time they've gained a lot of popularity. Not because they were new, but because people were looking for ways more than just one thing to do with their money. Because if you really think about it, most people are doing one of three things with their money. It's sitting in a bank, earning something like 1%. It's in the stock market going up and down with absolutely no safety net. Or it's trapped in a 401k where you don't have access to it when you need it most. And IUL mirrors what the stock market does. So historically, the S&P 500 has gained about 8 to 10% yearly. An IUL is designed to follow that growth. But here's the difference. When the market goes up, you benefit. But when the market goes down, you don't lose your money. Because there's a floor built into the policy, usually 0%. So if the market drops, you don't go backwards. You just don't gain anything that year. Think about that. Most people are used to up, down, but with this, you keep the upside and completely avoid the downside. That alone changes the way that your money behaves over time. And then there's this part, the money that grows within the policy, you can access it when you need it through loans, and those loans are tax-free. So instead of penalties, restrictions, or locking your money away, you have control. And the reason all this is possible is because an IUL is structured all under a specific part of the tax code, section 7702, which means that it's treated differently than traditional accounts. So it plays by a different set of rules because it's life insurance. And that's where something really important comes in. While all this is happening, building money, growing over time, giving you access when you need it, there's also something else built into it. If something were to happen to you, your family doesn't have to figure things out financially, struggle to replace your income, or make hard decisions during an already difficult time. That protection is already there. And depending on how it's structured, IUL policies can generate up to hundreds of thousands and even $1 million or more in death benefits for your family. And on the other side of that, while you're still here, most policies allow up to 80% of those benefits while you're still alive to help cover medical expenses, family bills, or anything else you want to use it for. Now compare that to what most people, maybe even yourself, already have. A lot of people rely on term insurance. And term is great, but it's temporary. In many cases, it's tied to your job. So if your job goes away, so can your coverages. Then there's the 401k, which grows, but you can only access it when you're 59 and a half years old. And along the way, it's being taxed yearly. So it's like trying to fill a bucket of water while there's a slow drip happening at the same time. And then there's people that are self-employed or work with a 1099 who don't have either set up properly. Now, this isn't to say that term or whole life insurance are bad. They're not. They just do less than what an IUL policy is designed to do. Think about it like this. Term insurance is like renting a home. You're covered, but you're not building anything. Whole life is like owning a home. You're building equity over time. An IUL is like owning commercial property, where the returns can be 2, 3 to 4 times greater because it mirrors the movement of the market. But here's the important part. Everything I just explained is general. What actually matters is what this looks like for you, because your age, your health, your goals, those are the things that actually determine how this is structured. So what I'm gonna do is follow up with you and walk you through what you personally qualify for, so you can see what it costs, how much protection you can get, and how this would actually work in your situation. And from there, you can decide if it makes sense for you. Now, just so you know, I am licensed and insured and work with over 30 A+ carriers. So the goal is not to just push one option, but to find the one that works best for you.